the macro, crypto, the ETH merge, ETH yields, why it all matters. But the point being is macro is the driver of everything. And once you understand that, you understand where the world should be going. Oil, which have been leaders, will not do as well. Commodities will get hit because of demand destruction, and we'll eventually see bonds rolling over, and probably more so oil. And as we see that trigger, we will see the kind of growthier end of the market starting to outperform. So that had been my base case for a while, and I've been counting it down and showing people. I've showed it on Twitter, I've been writing about it in depth and talking on Daily Briefing about it. And also on Real Vision, I've had some updates. But basically, it's now become clear from the forward-looking data, the Philly Fed and everything else is just showing it. But if you start to look at the really forward data, like the new orders component of all the regional Fed surveys, they're pricing things like ISM at 35. These are shocking declines, which I've been trying to tell people about, is economic growth over the next 3 months is going to shock people to the downside. And I can see that globally happening as well. And so that's what I think we're setting up for. I think it's not next week, the week after is ISM. That's the big one for me, because I'm expecting ISM to either hit 50 or even go through it, which would kind of surprise people. But I think it goes below 40 in the next 2 to 3 months, which is not what people are expecting. And that changes how the markets are positioned. So the markets are very positioned, still short bonds and underweight bonds. People are massively underweight equities now. And they were and still are underweight crypto. And that's not the general public, but that is people like crypto hedge funds, massively underweight. Some of them have so much cash. And people are still overweight commodities. Doesn't mean we go all the way back to the pre-COVID levels where many of the markets have got to, but we're going to retrace a lot more of that. My base case is that oil comes down somewhere between $80 and $60, to $80 and $60. The equity markets are somewhat more complicated because they're already pricing in. The S&P is pricing in ISM around 45, so there's a bit more room. The NASDAQ is around about 40. So it's pretty much priced in what I think is coming. My forward-looking indicators, which I'll show in a minute, will suggest that the bottom of the economic trough is like March next year. But I think stocks bottom first. So in 2018, they bottom a year before the economy. In 1974, these are the parallels I've been using. It bottomed 3 months before. So it's somewhere between that. So I think they bottom in the next few months, or they have bottomed, which is contrary to what most people think. If they price in the ISM properly, there should be another leg lower, and that should be the final leg for me. But crypto did really well. It's now overbought. We're putting in like DMARC 9 patterns, which tend to be a short-term correction. Now, do we go back to retest the lows based on the growth numbers and other stuff? I don't think so. I think we're more sideways consolidation than another rip higher, but it's not clear to me. But I think the base is in, and I've been saying that for a while now, because crypto is a very forward-looking asset, and it will look further ahead than anybody else, and it's sniffing out the change in bond yields. So that brings me on to the most important part, which is bond yields. Bond yields are now rolling over. As I've been forecasting, they're about to break a head and shoulders top pattern. So if it breaks that, then we should start to go down below 2%. I think somewhere around 175. So that's not what the market expects. But if you think of what that does to growthy assets, it's taking down the future discount rate. And if that means that inflation is coming lower, then you're taking some of the inflation expectations out. So things like what I refer to as the exponential age stocks, the further out the growth curve, things like Scottish Mutual Trust in the UK, which I've just interviewed on Real Vision. They're amazing, some of the best tech investors in the world. They're going to be coming on. But also, whether it's the semiconductors, whether it's ARC, whether it's robotics, and all of this that I've got a whole basket of, these should start to stabilize and do okay. And we're starting to see that now, but it's still early days. So this is the financial conditions index that we put together. Pleased to announce Julian Bittle, who many people know, has joined Global Macro Investor as my head of macro research, and he put this chart together. And so what this shows is that financial conditions, this is the rate of change of the dollar, rate of change of yields, and rate of change of commodities, are showing a massive decline in growth. And it leads ISM by 9 months, which tells us that in 9 months' time, ISM will have bottomed because it's already ticking up. So when we map assets across them, and if anybody goes to my Twitter feed today, you'll see that all assets correlate to ISM except crypto, which I'll come on to. So they all correlate, all macro, it's all about the business cycle. If you don't understand that, then it's really difficult to navigate yourself around this world because you're flying blind. But when you look at it, this chart, what it's saying is bonds are the most mispriced of all assets. They're actually pricing the ISM at 65. Which is not where it is today. It's in the mid 50s, or mid to low 50s. Then it's high yield spreads, then it's small caps, then it's cyclicals. They're all kind of roughly in line with ISM, so these could move lower. S&P 500, as I said, is leading the ISM. It's at 45. The NASDAQ is getting down to 40, and that GMI exponential age basket is already pricing ISM at 35. Crypto isn't driven by the business cycle, but it's driven by global liquidity. So this is the global M2 deviation from trend. So it's the rate of change of M2 and how far it is away from trend. And it's about 1.5 standard deviations away from trend, and it's turning higher. That time it ever happens, both at the top and the bottom, leads to the turn in the crypto markets because liquidity drives crypto. Remember, this is not a cyclical asset, so it doesn't go back to where it was, like oil and commodities. It's a network adoption model that goes up and to the right over time with these big volatile bands. Now, a lot of people had the narrative that this was driven by the halving. Now, maybe the halving, which is a reduction of supply every 4 years in Bitcoin, is a factor because it's correlated with liquidity. So what you're doing, you put more liquidity into the markets, it leads to more people able to allocate capital into a low supply environment, which is the halving. You don't need the halving as a necessary precursor. Ethereum's about to have a triple halving event. I'm going to do a whole update over the weekend. I'm going to film for Real Vision members about all of this. The macro, crypto, the ETH merge, ETH yields, why it all matters. But the point being is macro is the driver of everything. And once you understand that, you understand where the world should be going.